Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Netflix. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Well, we're going to jump right into the VIX watch list today. We haven't had many opportunities over the last, I'm going to say, almost year and a half to talk about a lot of bearish trades. The marketplace right now is in a capitulation stage, if you will. We're having the market just not quite sure where it wants to go to next. So because of that, we're going to take an opportunity to talk about some of the bearish plays that are inside the options playbook. So let's start by looking at my VIX watch list and see what's going on in the markets. We currently have the VIX trading at 2168. It's down a little bit today, which makes sense because we have the S&P 500 index up almost 1%, NASDAQ up a little more than that, and the Russell 2000 leading the way up 1.5% on the day. Now, the fact that these three major indexes are up today isn't really the story, though. We're seeing the TNX, which is the SIBO 10-year interest rate. It tracks the interest rate of the 10-year. And we see that trading at about 1.9%. Now, the index reads 19.54. If you want to know where the interest rate is, you move the decimal point over 1, and we're at about 1.95 on the 10-year. Now, I'm going to highlight that on the chart. If we look over to the chart, now I'm going to move this around a little bit. We see that we got to go all the way back to November and December of 2019 before we've even been at these levels. So if we go even further back, we see that this was a real interesting area for interest rates overall. And I think that 2% level, first of all, it's a nice round number. And the marketplace seems to be okay. I'm surprised to see the VIX actually trading around the 20 level, 21% or so. I know we have an update going on in the VIX overall, but I feel like there should be a little bit more angst in the marketplace with interest rates bumping up against that 2% level in the 10-year and just in general, the feel of the Fed, inflation. We still see a lot of little things out there that are some tinder that could end up fueling the flame of a market downturn overall. So if we look at the 10-year, that to me is the bigger story. It's nice to see the NASDAQ and the S&P up today, but I'm going to run the charts gradually get worse here. We're going to start on the S&P 500 index. So if we look at the S&P 500 index, and let me zoom in a little bit on this, we see that we don't have our ducks in a row. We've had kind of a bearish market. It's nice that on the 200-day moving average, we came back into that channel. This was a scary area when we broke through, and we broke through that 200-day pretty hard. As a matter of fact, from the point that we came all the way down from the 50-day moving average all the way down to the 200-day, that was a very quick move to that level. It kind of slowed down when we got to the 200-day, and now we've bounced back. But the NASDAQ is even uglier than the chart on the S&P 500 index. So if we run to the NASDAQ, we're still below that 200-day. And we had what is called a death cross. And I do think add a little bit more weight to a death cross when you're talking about one of the slower moving averages passing through the 200-day moving average. So here we have the 20-day moving average going through the 200-day moving average, and there's just a lot of resistance right here in that NASDAQ area. Definitely looking a little bit more bearish than it is bullish overall. We had a lot of tech earnings last week. They were all the way across the board. We had 10, 15% moves either to the upside or downside in a lot of the FANG stocks, Facebook, Apple, Amazon, Netflix, Google, all those stocks had very big moves after their earnings, either to the upside or the downside. So very schizophrenic in the way that the market was reacting. And then lastly, if we look at the IWM, this chart is the scariest overall. And I'm going to zoom out a little bit here. These are actually a channel that I had drawn a long time ago that we actually were highlighting on the stock play of the day. And we have definitely, we broke out of that channel for a little bit. We actually hit a little bit of resistance here, going all the way back to this trend line that started at the upturn of the marketplace. The IWM, or the Russell 2000 index, this is the ETF that tracks it, really kind of led the markets higher. As you see right here, it was kind of the strength that was pulling us forward as we were coming out, or having the recovery from the pandemic situation overall. Stayed in a channel forever, had a breakout, bumped up against that long-term trend line there, and then it's just kind of been ugly ever since. So the Russell 2000 index, or the IWM, looking a little scary too. So we're gonna look at some bearish trades today. We're gonna look at, and I'm gonna highlight this right now in the options playbook. We're gonna look at a short call spread, and we're gonna use Netflix. Netflix is down more than a lot of the other FANG stocks overall, and it's showing some weakness in its chart. I'll jump back to the chart here in just a second, but I'd like an opportunity to talk a little bit about some bearish trades because we haven't talked about them that often. So kind of look for a stock that we could maybe sell some premium in. We still have an elevated VIX, even though in my thinking, kind of surprised to see the VIX trading around the 21, 22 level. I actually kind of think it should be more up towards the 23, 24, 25 level. And I think we're going to have to really keep a close eye on the 10-year yield and see where that is at overall, because that, I think, is the moral to the story. You're seeing a lot of those sectors like the financials, energy, those are the strong sectors in the marketplace. These are the sectors that like a bump up in interest rates overall. So short call spread, we're going to go and look at the Netflix chart before we get to our strategy. And I'm going to approach this like, if I'm a short call spread trader or a short put spread trader, what time frame do I like to sell my short call spreads and my short put spreads in? I usually, if I'm not around earnings, which we've already had earnings in a lot of the companies, there's still a few out there that are ready to announce, but the bulk of them have announced earnings. And I'm really just trying to capture premium. I'd like to go a little bit further out in time. And I'm doing this based off of what I'm seeing on the chart overall. Now, I have a Fibonacci that's drawn on the chart, and once I put my cursor over it, you'll be able to see it a little better. So here's the big downturn, the big gap down in Netflix. And we came back and showed some strength in the marketplace all the way back to the 61.8 level, which is right, let's call it 460-ish. I get up on the top of that. But once we hit that, we couldn't break through it. And we came down precipitously all the way down to the 400 level. So we're going to target that 460 area, and we're going to sell a short call spread, which wants the market to stay either where it's at or drift lower, and it can come up a little bit higher, but we really don't want it to come back to that 460 level. But we do see a little bit of resistance to the upside right around that level. So here's the trade that we're going to look at. Let me pull up the Ally Invest option chains. We see Netflix is up 46 cents on the day. I'm going to go out 45 days. Now, a lot of people, when they think of short spreads, they're like, I want time decay. I would rather sell a short-term spread and have that high rate of time decay. One of the problems with that is you're not looking at the fact that if that market does come roaring back and it is a shorter-term trade, that it goes against you a lot quicker too. So there's really not much you can do if you don't have any time embedded in your short spread. So ideally, I'd rather go out, maybe have a 15 to 20 day forecast, but I'm going to go all the way out to 45 days. I'm going to bring in a little bit more premium, but it gives me the opportunity to adjust the trade if it goes against me, or even just sell it and get out. If in the short term it moves hard against you, you won't lose as much on a longer term short spread as you would on a shorter term short spread, right? And what I'm talking about is if the market would come back and get in the money of your short option contract, that's going to hurt you more on a short-term option expiration as opposed to a longer term. So my approach when I'm selling a call spread in a stock like Netflix after earnings, this is the only time I would ever think of it. I don't want to be in Netflix going into earnings. The stock has a big tendency to move around earnings. So we're going to go 45 days, March 25th. The March 25th is going to be the expiration date. I'm going to scroll down. If I look at the 405 call and the 405 put going out this far in time, that means that we're talking about just under 50 points. We'll call it 47 points is about where the expected move is at. We're going to go beyond that. 405 plus 47. We're going to end up selling the 460 strike call. And if I run over and I look at the delta of that option contract, that means that we're selling the 19 delta. Now, you can make the argument, or some people will always say that that gives you a little bit of a hint into the probability of the stock getting 1 cent or more above that strike by the expiration date. That delta is kind of a hint to it. It's not an exact science, but it's showing us that there's about a 19% chance that the stock will finish above 460 by that expiration date. So a fairly high probability of success. Now, if I scroll down, I'm going to buy that. I'm going to sell that 460 strike call, and I'm going to buy the 465 strike call. We're going to go 5 points wide. I very rarely do wider spreads than that on the stock play of the day. We want to manage our risk by not going that wide on our spread. So the maximum that this spread could trade for would be that $5. We're bringing in about 68 cents. Now, the market has moved a little bit. That was 80 cents when I was first looking at it, and I like it a little bit higher, if we will, but Netflix has came down just a tad. Might adjust it and maybe go to the 455, but we're gonna roll with this as the paper trade for this week. And oh, by the way, if you have any questions, please put them in the chat box right now. I'll address them at the end of the show. So if you do have questions, I'm willing to try to address any questions that you may have. Now, I'm going to put this in the right rail. We're going to make this the official paper trade for the week. So what we're looking to do is we're going to go up further in time. We're going to sell the March 25th expiration 460 strike call. We're going to buy that same expiration 465 strike call. That's our protection. Looking to do this, we'll call it a net credit of 60 cents or 70 cents to the account. So we're going to go 70 cents on that net credit to the account. And that's how I would work this order. Got a little bit of a wide bid-ask spread, but I don't mind a little bit wider bid-ask spreads on short spreads, because if you're correct on your forecast, the market does go down, the prices of the option contracts will get smaller. The bid-ask spread will get a little bit tighter, and it should be okay to be able to close out your trade on the downside. And if you do ride it for the whole 45 days, the options would expire worthless if you're correct on your forecast. And then you don't have to worry about bid-ask spreads at all. You just keep that premium from when you sold that trade overall. All right, so the market is really moving against us at this point in time. We're going to keep it right at that 70-cent net credit to the account. But what has just happened? Okay, so we're up about 1/3%, only up $1.54 at this point in time. All right, net credit of 70 cents to the account. Okay, so now I'm going to scroll up here, and let's look at the profit and loss graph. And so here's where the underlying stock is at, right down around 402.50, right in that range. This is how high the market has to go to get to our short strike at that 460 level. And that's that level that we were targeting as far as the chart is concerned. Our risk is from 460 to 465. And from 465 on up, that's our maximum loss that we can get on the trade. If we get it done for a 70-cent net credit to the account, that's the maximum we can make on the trade. Maximum we could lose would be $5 minus 70 cents or $4.30 on the trade. And if I'm doing this trade, though, I'm going out further in time, which protects me a little bit if the market moves quickly up towards my short strike. If I'm ever doing a short spread, I might have an out saying that, okay, the maximum I could make is 70 cents. If the spread ever started trading for $1.40, double that, I would think to close it and get out. I don't ever want to lose more than the maximum that I could make on the trade. Or another way to look at it is, if it gets to 465 and I'm just falling asleep and I wake up one day and it's at 465 on Netflix, that means that my long option contract is an at-the-money option contract. Very rarely would I stay in any short spread at all if the market has moved quickly against me to that 465 strike. Why? I want to be able to sell an at-the-money option contract that is protecting me and get as much bang for my buck, as much time premium as possible. If it continues on up as expiration approaches, the long option contract doesn't help me as much as it does when we have a lot of time premium in that option contract. Okay, so that's the downside of the trade. If it lands anywhere in this area over the next 45 days, we're good. We're all fine with this trade overall. So with that said, we'll talk a little bit about the time frame. And if I see one question in here, and I'm going to address it because this is what I'm actually going to talk about a little bit here. And the question is from Cards from Kids. Why did you pick that expiration? And so we're going to go into that question a lot here over the next 30 seconds or so. So if I go out 45 days and I sell something for 70 cents, I'm going to talk about this relative to maybe selling a 20-day option for about half that price. So if we did a short spread and had a 20-day option and we sold it for 35 cents, half of that 70 cents, you don't have a lot of room to try to close out that trade, right? Because you're only bringing in a small amount of premium. And the last 10 cents, 5 cents on that trade is really hard to extract from it because of bid-ask spreads and just in general, the options need to go worthless in order for you to capture that whole 35 cents. So if my goal was to make 35 cents, I would rather go out to the 45-day period with the idea that in 20 days or so, I'm looking to close out that trade. I still get a good amount of time decay, and if the market stays in this range and I don't really have that risk, we're at voided earnings. You never know where the news cycle could come from, but the known news event has already happened this quarter overall. And if I sell this with the concept that I'm going to get out of it in about 20 days, my goal would then to be to try to close it right around 30, 35 cents. If it gets down to 20 cents, I'm probably going to close it for sure if I ride it that long overall. But it all depends on where it goes from here. Now, the only way that I would probably stay in this trade all the way to expiration is if the market actually started going down and the premium was dropping precipitously. If I could buy it back for 5 cents, I'm just going to do that. There's never a reason to try to capture that last 5 cents in my mind. I just close it out overall. But this is a strategy that we don't talk about much. It's a bear call spread, a short spread, where we are bearish on an underlying. Netflix has always had some price to earnings issues overall, and the valuation. They've always been a fairly expensive stock, but a lot of the tech stocks are in general. So we're going to take a little bit of the downturn from looking at the chart. We're going to try to sell some premium, try to capture some premium. We're going to do it by going out 45 days in time, have an outlook of about 20 days. If I'm selling this for 70 cents, if I can close this out for anywhere from 30 to 35 cents, I'm going to do that. On the upside, if I'm managing my risk, I can either try to let it ride all the way to that expiration date, say to myself, well, if I'm down, the maximum that I could make on the trade, 70 cents, or if it's trading for $1.40, think about getting out and closing that trade. And then that's going to be my plan going forward. But without a doubt, if it ever does get to 465, I don't necessarily care where the spread is at. I want to be able to sell my long option and capture as much time premium as possible. So that is also an area that I would think to just get out overall on the trade. All right. Thanks for coming. Please click subscribe, ring the bell, let people know about the stock play of the day. We'd like to, it's free for all, so we'd like to get as many people to join up. And that will be it for this episode of Stock Play of the Day. I'll be back on Friday, and we'll talk a little bit about this trade and see where we're at. Thanks for coming, everyone.